So I think there's really two mentalities of looking at your accountant or your tax assistants. Is this person a strategic partner, or are they a service provider to me? And there's no right answer to that, really. I think a lot of our clients, I see them for a couple of hours every year, and I prepare their corporate tax return, and we talk about if there's anything else I need to know going in there, and that's all we provide is the service. Then there's other clients. I mentioned to a couple of people, I'm actually third generation with the firm. My grandfather was one of the first and Company when Mr. Welsh hired a few and Company. And there are several clients that I deal with who are actually third generation on the client side as well. So you talk about service provider, and in those cases, it's a long-term relationship that we've been able to work with them. So it's really a question of what are your actual needs and what do you want out of the relationship with your accountant. Obviously, if they're a service provider, you're just paying them to do X, and they put it through and get that done and move on. If they're much more of a strategic partner, then you're going to be taking a lot more of their time and discussing a lot more things, and there's going to be incremental costs associated. So I think it's really what you need, but I just have a couple of points that I'd point out to do with if you're just using them as a service provider. Think about the old adage, it's a penny wise, a pound foolish. So if you are talking about trying to grow and sell your company, for example, if you qualify to be a qualifying small business corporation, which is just some planning that needs to be done, really, in terms of what actually is held within the corporation, you can qualify then for the capital gains exemption, which is worth $200,000 in tax savings to you. So really, this is something that, if you're having a few extra discussions with your accountant and you're thinking about selling, making sure you qualify to be a qualifying small business corporation is important. And some of the criteria have to be done 2 years in advance. So you want to be having this discussion and thinking about it with a good lead window, because otherwise you won't actually qualify. And to talk about that, the qualifying small business corporation, the capital gains exemption is available to every shareholder. So if you own, your spouse owns, your children own some shares, as much as there is actually capital gains on the value of those shares, every single one of you can take advantage of this $200,000 tax savings when you sell your company. So it's huge consideration if it's applicable. So something to be aware of. Holding corporations are another thing. We use a holding corporation a lot of the time to structure the qualifying small business corporation, because you have to have your assets involved in the active business for it to be a qualifying small business corporation. So if you're paying out to yourself, again, I mentioned earlier, your personal tax rate can be as high as 50%. If you're paying a dividend to a related company, you don't have to pay any tax on those dividends. So you're paying 15.5% on the income. You can pay a tax-free dividend to your related company. Well, to any company, you can pay a tax-free dividend if they're Canadian companies. And then you won't have to pay tax on that. The money stays in there. You can invest it in something else, but it means that you can maintain the qualifying small business status of the active business corporation. We also use holding companies a lot of the time for estate planning, or to change things, to bring other family members or other shareholders into the ownership structure. So again, there's a lot of things that can be done ahead of time, and there's a lot of value then, but you need to really be thinking about it. So yeah, holding corporations are another reason that you might want to talk to your accountant and just have those discussions. So yeah, then just be clear about what it is exactly that you want out of your accountant. And then the last one is you don't know what you don't know. So these are just a couple of the things that I see quite regularly with clients that they have trouble with and don't know about. So HST and GST, we have what's called the place of supply rules that determine which rate of GST you should be charging. So if you're in Ontario, if you're operating in Ontario, you're selling to customers who are in Ontario, if everything is Ontario, you're going to be charging the Ontario rate. If your customer is in Manitoba, you may end up in a scenario where you should be charging the Manitoba rate. And it really depends on what the service or good is that you're providing, how it's being provided, and there's a list of detailed rules that depend based on the nature of the actual supply and common sort of types of things would be whether if you're selling publications or physical goods, if they're being shipped somewhere, quite often it's the place of the shipper, that they're being shipped to that the rate will apply. If it's internet data, quite often it's the place of the purchaser that the rate applies. So this is, HST and GST is a very complex issue, and I don't say that I know all that much about it, but there is somebody who I would talk to if I had questions, and I would definitely want to be addressing those issues if you are dealing with people outside of the province, outside of the country, because it can get very complex and very detail-oriented. GST, another thing that we see a lot of smaller, particularly service provider businesses, is the quick method. So if you have sales which are less than 400,000 within the last 4 out of 5 quarters, you can be eligible to use the quick method. To use the quick method, again, like the qualifying small business corporation, you have to make an election ahead of time. It has to be done ahead of time or else you can't use this. But I have one client within the past 2 weeks that I've done this for, and based on his expected sales over the next year, which is only $30,000, he'll save $1,500, which is 5%. So, you know, as it grows, that can be a significant savings. And it's a specific method of reporting GST. It means that instead of actually recording all of the GST that you collect from your customers and all of the GST that you pay separately, and then netting the two out, which is the way you would normally do your GST return, in this case, you just take your total revenues that are GST eligible or applicable, and you would multiply that by the fixed rate, which is the quick rate. For most businesses, I think it's 7.8% on the first 30,000 and 8.8 after that. And you use that rate. And so if you're in a situation where you're not spending as much with things that have GST on them as you're actually selling, then there can be a significant savings here, which is why we find with service corporations particularly, where the majority of their costs are actually related to salaries rather than related to purchase of goods, this can be really significant savings. And then the final one is tax credits. So we've talked a little bit about the SHRED program, which is for qualifying expenditures related to scientific research and experimental development. This is probably the most common and well-known tax incentive program run by the CRA. And basically, if you're trying to advance knowledge of your company's knowledge in terms of experimental development or research to something, and it doesn't necessarily need to be entirely groundbreaking, it's just something that isn't in the public sphere that you can't otherwise have access to. If it's something that you can't go out and purchase necessarily, if you're trying to develop something new that your competitor has already done, but you can't get their proprietary information, you can still be eligible for it. So it's any salaries, related expenses in terms of materials or other contractors' fees that relate to the actual development of something that you're trying to push technology beyond your own capabilities, you may be able to qualify for this program, and so your accountant can probably help you with that. Particularly the Ontario Digital Media Tax Credits. I find that a lot of people are unaware of this. And we had actually one client come in, well, it wasn't a client, it was somebody who was coming in about a month ago trying to pitch their digital media tool to us as something that we might, with our business, want to use. And just out of curiosity, I asked them, because it was very much a digital media platform delivering something to us, do you guys claim these? And they didn't. And this is a company that's probably spent about $1 million in eligible expenses, and they didn't realize that they're eligible for a credit of 40% of their eligible expenses. So they're probably going to get a refund now, or we're just looking into all the details and about to start preparing the claim to file, somewhere between $250,000 and $300,000 for them. You don't know what you don't know. So if you are working with your accountant as more than a service provider, as a partner, tell them a little bit about your business, tell them what you're doing, tell them where you want to go, and they may be able to point you in some good directions, hopefully as good as that. And the other thing about Ontario digital media tax credits, which is often very exciting to people, is that it's worth up to $100,000. You can claim up to $100,000, so $40,000 refund on marketing expenses for each product, which is, it's the only tax credit or government incentive I'm aware of that really does help with marketing of your product as well. And again, so it's for digital media related things where you're trying to educate, inform people with your digital media tool.